Yo everyone, I'm Yogesh and today I'm going to talk about stock pick among Dow 30 companies. We were given the task of choosing a single company for our portfolio among Dow 30 companies. Dow 30 companies represent companies from different industries which further represent the overall economy. My selection criteria first. I looked at the risk and return relationship while choosing the company. For that, I created an efficient frontier where my measure of return was the 5-year average return on equity. ROE is the single most important ratio for a company to look at. And my measure of risk, I use the standard deviation of return on equity as well as beta, which I do it in my further analysis. The companies falling on the efficient frontier is what I chose from. At this point, it basically boils down to risk preferences. However, I did financial analysis of the companies that fall on this frontier to help me make a better decision. The efficient frontier. As you can see, I have 4 companies on the efficient frontier: Bank of America, McDonald's, IBM, and Boeing. As you can see, Boeing has the highest level of risk in terms of standard deviation, a whopping 28.178, and Bank of America has the lowest risk in standard deviation. The returns are very low as well. And Boeing has a pretty high return. McDonald's and IBM both fall in the moderate level of zone. However, IBM has pretty high risk too. The betas for the company that fall on this efficient frontier, well, surprisingly, Bank of America has a really high beta, and this can be associated to the financial downturn in the 2007-2008, where banks were hit very hard. And McDonald's obviously has the lowest beta, and Boeing, as shown by the standard deviation, has a pretty high beta. After I had the companies falling on this efficient frontier, I looked at some of the financial ratios to help me make a better decision. My first criteria was looking at the DuPont analysis, which breaks down the return on equity into 5 different ratios that help us know on the profitability of the company, the asset management, as well as the financial leverage. Liquidity, how a company can handle its current liabilities with the current assets it has, using the current ratio, and further looking at the quick ratio and the cash reserves using the cash ratio. How the market thinks about the company, that's what drives the stock market up. So we are looking at the price to earnings ratio, price to book ratio, and some of the market statistics for the company. And some further economic value added and weighted average cost of capital analysis, and also looking at the supply chain, how diversified the company is. My pick, I decided to go with McDonald's because I felt that the risk and the returns were appropriate for me to take for McDonald's because it didn't have a really high risk and the returns were in the moderate level of zone. My major reasons over other companies: Bank of America, it was highly leveraged, it had high market risk, and of course there was a negative EVA for the last 5 years. As you can see, I have broken down the ROE into profit margin, asset turnover, and equity multiplier. The equity multiplier is very high, and this is below performance for the industry average. IBM, it certainly has a very high ROE, but it is driven purely by high equity multiplier. This is investors do not want to take on a whole lot of risk if the company is highly leveraged. As you can see, the equity multiplier is 6.0425, and Microsoft, which is a fellow Dow 30 company, has an equity multiplier of 2. So you can see the company is 3 times more leveraged than the average industry company. Boeing Corporation, yes, very high ROE, but very high risk. And the main problem with Boeing is it is not well diversified at all in terms of supply chain, the number of customers it has. That is mainly US Department of Defense. So now, about McDonald's, a little bit of history on the company. The company started in 1940 as a barbecue restaurant operated by Richard and Morris McDonald. In 1965, it went public and was listed on the stock exchange. So it has a long history behind itself and has been in the restaurant industry for a while. Currently, it's the world's largest chain of hamburger food restaurants. It serves 68 million customers in 119 countries. Presently, it's in the leadership of CEO Mr. Don Thompson. We look on the return on equity for McDonald's. 2008, the return on equity was 30.0966, and 2011 it was 36.821. The geometric return, 4.5%, it might not be much, but I think it's pretty good in terms of the period that the company had to go through during the financial crisis. So it has been able to move up its ROE in spite of the recession that we have been into. I also looked at some of their competitors' 2012 ROE. Yum Brands, which has Taco Bell, Pizza Hut under its brand, had a whooping 63.16%, which is pretty impressive. Wendy's and Burger King, that we all know about, have ROE which are pretty less. Wendy's 0.4% and Burger King 12.07%. DuPont analysis. First, we start with profitability, looking at the profit margin and further breaking it down into interest burden, tax burden, and operating margin. The profit margin in 2012 was 19.827% for McDonald's, and this has been consistent over the past 5 years, so which is a pretty good indicator of the profitability. As you can see, the interest burden is 93.8044, so the company has taken on debt and has some interest expense. The company falls in a pretty high tax margin, and the operating margin is strong, and that's the reason the profit margins turned up pretty good at the end too. And we can also observe an increasing trend in the operating margin, where it was 28% in 2008, and it has gradually gone up to 31% in 2012. Now, the next point, we look at the asset management. How is the company utilizing its asset to generate sales and net income? The return on assets, which is a measure of how much income the company is generating with each dollar invested in assets. So with each dollar invested in assets, the company is generating 15.9845% of net income, which is pretty high. And the asset turnover ratio, which gives us the amount of sales the company is making in terms of each dollar invested in assets, it's 0.8063, where the company can definitely improve. Because when I was looking at the indicator, when I was looking at the competitors, as you can see, Yum Brands has a pretty high return on asset and a very high asset turnover ratio. So if you had paid attention, its ROE was pretty high, and it's driven solely by asset turnover ratio. So McDonald's can definitely improve in this area. However, it is doing well than its other two competitors, Wendy's and Burger King. And all these ratios, it's been stable and consistent for McDonald's. So consistency and certainty is what investors like, and we can look at over here in its financials. Leverage, very important concept for leverage. How much debt the company is taking, and how debt is driving up its ROE. The leverage for McDonald's, the asset to equity ratio, is 2.3035. There has been no significant change in the last 5 years. I was looking at the industry average, and it falls right within the industry average. The competitors, Yum Brands, it's right there with McDonald's. Wendy's has a pretty low leverage, which is pretty good, but their company's ROE is not good, so they might take on more debt to increase the company's ROE. Burger King has a pretty high equity multiplier, and investors, this can make the investors worry about the company. So yes, leverage. Liquidity, sorry. Let's look at the liquidity and how the company can afford its liabilities, current liabilities, with the current assets it has. Its current ratio, normally the investors say that the ratio should be 1, so that company can afford its current liabilities. The current ratio is 1.4464. The quick ratio, which excludes the inventory, is 1.0906, and the cash ratio, which is where we're looking at the cash the company has, at 0.6865. So basically, for each dollar of liability it has, the company has 68 cents in cash to cover it. But as you know, it's the The sales and the turnover is pretty high for McDonald's, so I don't think this is a problematic area for the company. As you can see, the company has more in current assets to cover its current liabilities, and this has been consistent even in times of economic crisis. In fact, the company's performance has been slightly up during the economic crisis. I mean, who doesn't eat a dollar menu for McDonald's, right? It's cheap. So if it's a recession, I ain't gonna go to Pizza Hut, I ain't gonna go Domino's. I'm gonna go to McDonald's and eat the dollar menu. Market statistics. Now, it's very important to see what the market thinks about us. Our financials are good, but how is the stock price doing? Because that determines your market cap, that determines your price to earnings ratio. Whenever investors are making a stock decision, these are the tidbits that they just look at to get a snapshot of the company. The market cap is pretty high, 101.17 billion. I was looking at the competitors and I did not see any specific brand that is even close to this market cap. For example, Yum Brands, its market cap is just 30 billion. So McDonald's has a pretty high market capitalization. The stock price as of 27th of April was $100.94, which is pretty good. You can see the volume. You can see the price to earnings ratio, 16.42. Normally for a company that's matured, that's in the matured phase, it should be average is a 15. And for this sector, for the industry sector, for restaurants, the PE is actually below, which we'll further look in our further slides. The price to book, the earnings per share for trailing 12 months was 5.39. It has a strong dividend yield. So the investors like the dividends that they're receiving from the company. Market ratios, and let's look at how we can get an idea of their stock price and if it's undervalued or overvalued. The 5-year average PE ratio for the company was 16.95. The industry PE ratio, as I derived it from Yahoo Finance, was 19.3. And the 5-year average price to book ratio, 5.68. And the industry price to book ratio is high, 12.7. So both ratios suggest that the company is undervalued and the stock has upside potential. I read through some of the analyst estimates for 2013 fiscal year for the earnings per share, and it's estimated to be 5.71 per share. And I tried to derive a target price using the 19x price to ratio, which is the company average, which is the industry average, and the target price comes up to $108.74. So this shows us that the stock is undervalued and the stock has a 9% upside potential, which is a pretty good return considering the historic low interest rates and the returns that we're getting right now on our other investments. And yes, the risk is not too high as well. Sticky dividends. We all like sticky dividends. The company has been paying dividends since a whole lot past years, and the historical data shows that sticky dividends paid to the stockholders 2008 to 2012, it has been strong, to 2.613 per share in 2008 and to 3.2536 per share in 2012. So we definitely like return on our investment. Next, I looked at the economic value added for the company. McDonald's has generated positive economic value for the previous 5 years. In 2008, its EVA was 2322.4 million, or a spread of 9.56%. So this is what the company is making over and above the required return on the invested capital by investors. For example, the weighted average cost of capital was 8.4%, where the mix of equity and debt was 89.8% for equity and 10.2% for debt. And we weighted according to the cost of equity and cost of debt to calculate the weighted average cost of capital. In 2012, the EVA is pretty high, 13.16%. The company is definitely generating net income in excess of what the investors require on their money. Finally, we look at the supply chain. Just 32 suppliers in total, as you can expect for a fast food company. And I got this data from their own website. The major suppliers they have: the Gavina Gourmet Coffee, that supplies the delicious coffee that you can consume in the morning at McDonald's. low pace foods, the beef patties, 100% pure beef patties. That's who produces them. And the famous McNuggets, chicken McNuggets, it's produced by Keystone Foods. And fries. Ooh, everyone loves fries from McDonald's. 100 Circle Farms, that's who supplied in potatoes for the world famous fries. Customers, we are the customers. The direct customer base to franchise stores. You can see a lot of franchisee stores from McDonald's at different places in all over the world, and that's where you can purchase one of those tasty and delicious hamburgers. Hence, to conclude, I have to say that I think it's a pretty good pick because the returns and the risk relationship is in the moderate level, and it's definitely my preference to go for a company that has moderate level of risk and moderate level of returns, because time of uncertainty, you never know what's happening to the stock market. So it's definitely true. It's definitely good to take a safe bet on the investment. Thank you.